let's get right on into it. General qualifications, okay? So the difference between the program today, the My Choice, and last week is there's no first-time homebuyer requirement, and that's huge. If you don't know, quick definition, first-time homebuyer is anyone that meets the following conditions. You've had ownership interest in a primary residential home within the last 3 years. Okay. And so if you meet that test or if you need help determining if that's you, again, you could reach out to myself or your lender of choice. But this program does not have that first time home buyer requirement. So that's a plus. Secondly, the maximum income limits, okay, maximum income limits apply only based on what the program states. And again, you want to reach out to your lender once you get into that application stage, and they can let you know what that uh, income limit is. It's very generous though, so don't think it's a meager amount because it's not. There is homebuyer education requirement for the borrower, and if you have a spouse. Texas is a community property state, and so what that means is, regardless of if either you or your spouse is not on the actual loan, the deed, the ownership of the property will be in both names. Therefore, both, right, non-purchasing spouse, if that's the case, and the spouse that's on the loan will have to take the education requirements. All borrowers must occupy the property as a primary residence within 60 days of closing of the loan. The home must be located within the state of Texas. And the loan, based upon what loan type you're using, FHA, VA, or USDA, must meet those guidelines. Okay. And again, that's something that your lender of choice will be able to ferret out for you. Okay. So let's move forward. Eligible, properties. So you can do a brand new construction or an existing or pre-existing home. One thing I will say, if you're going to go new construction and it's with a builder that's offering some type of incentive, go directly to that loan officer because of the builder, unless the builder is saying that you can use your own lender and still get whatever incentives that they're offering. Because if not, you're just wasting time. And respectfully, a lot of these builders, they're getting a ton of leads, ton of business, and you're not the priority at all points in time. You want to make sure you stay on top of those things to make sure that that lender understands the program and is able to explain it to you. But again, if you're going new construction and the new construction incentives, if any, are tied to using that lender, go directly to the source. No need of wasting time, okay? Unless they say you can use an outside lender and still get any incentives that they would be offering. But condominiums are eligible properties. Homes that are in PUDs, planned unit developments, think HOAs, homeowner associations, those are eligible. Manufactured homes, okay, single wide and double wide, as long as they're real property, meaning the wheels and the tongue have been removed, it's been properly affixed to the land, and it's showing up in the county as real property. So those are eligible. And if you're buying new and you're going to be fixing that property to the land, again, we can help you with that as well with these types of down payment, or this specific type of down payment assistance program. And then duplex, no triplex or fourplex, but duplex are eligible if someone has occupied it as owner occupied, and there's a 5-year occupancy rule that has to apply, okay? Unless that duplex is in a targeted area. So again, these are things that your lender of choice should be able to ferret out for you to make sure that these things, if you're interested, are going to be applicable with your specific situation. Let's move forward. So now your credit, FICO, Fair Isaac credit score or credit scores, and your DTI, debt to income requirements. With this program, again, they made some changes at the beginning of first quarter of this year. And so you want to pay attention, but the minimum credit score is a 620. The minimum is a 620. And then the maximum debt to income ratio, okay? So 0 up to 45%. You don't have to have any reserve requirements, all right? Pay attention. Number two, if you have a 45.01% to a 50% debt to income ratio, back end ratio, then you are required to have 3 months of whatever the proposed house payment is, principal, interest, taxes, and insurance. You got to have 3 months after closing, after everything is, all the closing fees and the settlement has taken place, in some sort of account that you can liquidate. Okay. Now, back to the first bullet point. If you have a 0 to 45% debt to income ratio, you don't have any reserve requirements. However, if your new proposed payment is 1.5 times greater, or 51% greater than what your current rental payment is now, then, okay, you do have to have that 3 months principal, interest, tax, and insurance reserves. If you fall within both of those requirements, you don't have to have 6. 3 is the test. But as an example, say you have, let's see here. Let's say you have $1,000 rent payment now, okay? If you multiply that times 150%, basically what we're saying is if the new house payment is, say, $1,501, then you must have the 3 months reserves, 3 months PITI, even if your debt to income ratio is less than or equal to 45%. Okay, and let's scroll that up here. Sorry. So that's something, again, you want to be dealing with someone that understands how to navigate your specific situation, because you don't want any gotchas after you've put up earnest money, paid for an inspection, and potentially have those, well, the inspection is gone, but potentially have the earnest money in jeopardy because the proper qualification was not done up front. Let's move forward. Excuse me here. I want to do that. Let's go over here. Now, talking about income limits and area median income, AMI considerations. All right. So as a borrower, the only income limits apply are the household income. Income limits apply. Household income for this program considers only the applicant's current gross income. Okay. Income excludes any non-purchasing spouse, which is nice, right? So both people, if you have a spouse, have to take the down payment assistance course, but only the applicant income is what we're using to make sure we fit within the income guidelines for this program. So that's nice because, again, if you're thinking outside of the box, you may have more income, but you don't have all of the down payment and closing costs that you need. This might be a strategy dealing with the right professional that knows how to put things together where you could potentially get into a home with a scenario such as that. But the types of incomes that are looked at, okay, your annual wages, as far as the gross W-2 income, any annuities that you have coming in from an insurance situation or Social Security, pensions, retirement, any bonuses, a child support, self-employed, plus the depreciation, if you can add things back in for depreciation, alimony, dividends, public assistance, interest income. Again, it's very important to deal with someone that knows how to properly qualify. Your applications are very important on all loans, but on these very much so before you start running looking at everything or anything. So you got to make sure all the I's are dotted, T's are crossed. Annual median income considerations. It says borrowers with income under 80% of the area median income may qualify for additional benefits. Okay. You can use the Fannie Mae or Freddie Mac tool, and we'll put it down in the description. Or if you need some more help with that, you can reach out or send me a message and I'll get you that information. Because here's the thing before I move forward. There's a lot of information online, but you really have to find out what fits you specifically. Okay. This is a bespoke situation to your specific income, assets, credit, the whole nine. So use these videos to get an understanding of what's available, okay, and what you might want to go after. But then, and I would recommend at the latest 45 days before you start really going to look, If you could go 60 days out, that would really be ideal to make sure and understand what you really qualify for as it pertains to one of these programs. Let's move forward. Let's see here. Do homebuyer education, kind of went over it briefly, but it's required for all borrowers, including non-purchasing spouses. So we're going to put a check there, right? The Texas Department of Housing and Community Affairs offers a free online course, Becoming a Homeowner. It's excellent. And again, this is different from the not state, but the city type down payment assistance programs, where some of them require that you go take a physical 8-hour course and physically have to be there. This is something that's done online. And honestly, if you're watching my videos or folks like me, you're going to know more than what you need to know, but you'll be able to breeze through one of these online courses, and it's able to spark questions that you may have not had answered. And what I tell my clients and folks that I'm blessed to work with, this is a good indicator. Okay, you can take this up front. You'll have the certificate. If you're going to use down payment assistance, you'll need it, even if you're not. But you could really gauge a great loan officer based upon some of the stuff that they ask you or take you through to prepare, or if they're just somebody that's like a car salesman trying to close a loan. So that's a great resource for all of those reasons. So we'll put a check mark there. And then when you're finished, you're going to get a certificate of completion, and you want to keep that because you'll have to give that to your lender, because that's a part of the underwriting process to show that you've successfully completed that course. Okay, so pretty straightforward on that. Let's move forward. Now, program assistance, or how are the down payment programs, how do they work? Excellent question. Sorry about that. And bottom line, here's the deal. The assistance comes in a range between 2 to 5% of the total loan amount. Okay. I'll just leave that there. I'm going to make another video kind of going a little deeper, but that's not the scope of the video today. But 2 to 5% of the total loan amount, less the program fees, the down payment assistance fees, because there's fees for all the programs, and then the difference of that is what you'll get. Okay. Now, with that said, let me put a check there. If there's extra monies left over, you will not get those monies. The only monies that you can be reimbursed on the cash back are those monies that you paid for qualified, paid outside of closing fees, appraisal, maybe an termite inspection or survey or what have you. It's all based upon, again, your specific situation and what was negotiated. But if there's monies left over from the down payment assistance, it's either going to be applied as a principal reduction to your loan amount, which is a good thing, but you can't get those extra monies back. I get this question a lot, and it's a good question. It's not a bad question, but if I have monies left over, can I use that money to buy furniture and things of that nature? Answer is no. The only monies that you could get back are the monies that you paid for up front that have been verified, that have come out of your account, that you can be reimbursed at the time of closing if any money's left over. If not, those monies will be used to do a principal reduction of the loan. Okay. And then while I'm on that point, you cannot, on these programs, buy down the interest rate via discount points or anything of that nature. The program determines what the interest rate is. So in essence, that's one of the costs of doing down payment assistance. And then lastly, the options, it comes in the form of a second lien. That's a deferred payment loan. With this program, there's only 2 options. Okay. You either have to pay the money back at some time over the 30-year amortization. You could pay it back sooner. There's no prepayment penalties. There's no interest on that second because the interest is tied to the first lien. Okay. But you could pay it off. If you refinance, say a couple of years down the line, home equity goes up and you want to pay that thing back sooner to get a lower rate, at that time, whatever is left over that you haven't accelerated, you'll have to pay those monies back. Okay. Now, there's a forgivable version. The rate's going to be higher, but on that forgivable version, if you keep said loan for 3 years, then month 37, all the money that you got is forgiven. So again, It's a case-by-case scenario. Now that we're in a little higher rate environment, may not want to go that option. A couple of years ago, had a lot of folks doing it because it made sense. The rates are lower. They're going to ride out the 3-year period. Again, there's no right or wrong answer. It's just based upon what works for you and your specific situation. Let's move forward. Let's see here. Program benefits, right? So there's no purchase price limits with this program. There's a maximum income qualification that you have to meet depending on what county you're buying in. But as far as the purchase prices are concerned, there's no maximum. So as long as you don't exceed the maximum FHA purchase limit in the county that you're buying in, you're good to go as long as you qualify. And really, USDA and VA don't have a maximum loan amount, but as long as you meet the requirements, okay, as far as those specific programs and the income piece, then you're good to go. There's no recapture tax with this program because it's not one of those revenue bonds like the My First Texas scenario where we have to get the 3-year tax returns and things of that nature. There's a potential for recapture tax with some of those. And we'll do a video coming shortly about recapture tax because never had anybody meet the recapture tax test because in essence, 3 things have to happen. All of them have to be applicable. And if those 3 things happen, you're well off. And if you have to pay some of that money back that you didn't have to get in the home, then you wouldn't have a problem. But like I said, never had it happen. And I've been doing DPAs for a solid 16 years now. And then this program and others. I digress. Tax returns are not required. Again, because there's not a revenue bond like for the first-time homebuyers, then we don't have to validate your past 3 years tax returns. Okay. So you can have another home that you own with this program. The new home that you're going into just has to be your primary residence within the 60 days. Once again, that's something that you and your lender can discuss. If that's us, we can get you straight along those lines. Okay. So last and most definitely not least, we're going to talk about the insurance requirements. And this is huge nowadays, right? Because insurance is going up for whatever reason. And this is something that you really want to pay attention to. But as far as the coverage, you must have a loan amount or a replacement cost. God forbid something happens, like my home. God forbid something happens to it and it has to be fully replaced. So you have to understand that the land is still going to be there. So the replacement cost estimator is something that the insurance company says, you know what, if we have to replace this home based upon what costs are today, input costs, labor, things of that nature, and forecasting for the future, then they're saying, hey, it's based, this is the premium amount. So got to make sure you have that. Now, from there, your max deductible with these programs, okay, is going to be $2,500 or 2% of whatever that replacement cost is, that premium, and the higher one applies. And the reason you might want a higher deductible now is because it can help lower your overall premiums. But again, that's something that we need to talk about because we don't want to put you in a spot with a higher deductible to have a lower monthly payment to get in a home because you might not have those monies. So it's all about planning, right? We're back to planning. But with that said, if your insurance is broken up into separate policies, as an example, your primary homeowner's insurance policy, and then you might have different riders for wind and storm or wind or flood based upon where you are, it might be applicable. If that's the case, if those deductibles are applied to each individual or extra insurance, max deductible is $5,000 or 2.5%, whichever is higher. All right. And all this is designed to protect you. And you don't have to worry about it because we got a great lender. Again, we're not over here. That's all I can speak of. We really partner with you to help you understand so you don't have any buyer's remorse and really get on that property ladder and have it be a blessing to you. So with all of that said, if you made it to the end of this video, you probably are interested in down payment assistance programs here in the state of Texas, right? And you would want to, if you missed last week, go back and look at the My First Texas Home Down Payment Assistance by TDHCA. That's the organization that I'm focusing on over these next 4 or 5 videos to make sure we cover everything. But if you missed that one, go back and check that out if you're a first-time home buyer. Or you can subscribe to the YouTube channel, because that's where we put long form information like this, so you can continue to educate yourself until the time that you're ready to reach out. So you would just jump on YouTube and search at LEND, the number 2 USA. And you know what? This is what it looks like on the screen right here. When it comes up, this is the channel. And our motto is, we simplify the home loan process. So if that's you and you're ready to take the step, reach out. The information will be here on the YouTube channel on how you can schedule a consultation. If not, continue to educate yourself, be encouraged, and know this: when you consider the full matter of anything that you do, when you go out and do it, that's when you'll have your best success. So until the next time, you guys be blessed, and we'll talk to you soon. Peace.